Welcome to the Self-Storage Development Podcast, the show where we take you behind the scenes of building Class A self-storage from the dirt up. I'm Brady McDonald, the founder of Barefoot Land Co., and in every episode, we dive deep into the deals, the entitlements, the wins, and the real-life stories behind the people building storage across the country. From personal lessons to development insights, this is your no-fluff playbook for sourcing, developing, and investing in self-storage. Let's get into it. All right, ladies and gentlemen, welcome to the Self-Storage Development Podcast. I've got my great friend here, Arthur Hood. Welcome, Arthur.
Good to be here. Good to see y'all.
Yeah, thanks a lot for coming in. All right, now, I look up to you as, one of the guys that do more storage development than anybody I know personally. And so, obviously I know who you are, but our listeners don't. Why don't you just give us some Coles notes about who Arthur is with regards to self-storage development?
I started in real estate development 20 years ago, but in real estate development, finance, I own operating businesses, so a pretty diverse portfolio. About 4 years ago, got very heavy in ownership and development of self-storage. And in the last couple of years, we've really kind of blown that up. We formed a partnership with a good friend of mine, Russ Colvin, who had built a big $2.5 billion self-storage portfolio. That he exited that, but he was more of a manager and a small partner in that company. He formed a company. I'm the second, third largest shareholder in the company, and we decided to grow that to a massive self-storage company. We started in the development space, so we're developing self-storage, ground up entitlement, and developing. We're starting to do some value adds now, but we really want to build that to a pretty massive portfolio. We'd like to get it to, 3 to 7 billion in the next, 5 to 7 years, and potentially exit into a REIT.
Yeah. Awesome. So let's just back up a little bit. So you've got, you guys are obviously created a partnership, and we want to get into that because that is one of the ways that we've created a lot of our wealth is through joint venture partnerships. So I want to unpack on, how you structure your partnerships. But before we do that, let's go back a little bit. Like, where did Arthur grow up? What's a little bit of your backstory?
I grew up in Birmingham, Alabama. We had family friends who were in the excavating business, and then I had some friends with farms, and I kind of grew up ever since I was probably 6 years old, running heavy equipment, bulldozers, tractors on the farm, mining equipment, and just grew up around that, which I think really helps you with a different skill set. I mean, from mechanicking to building to construction. So just kind of always there. As I got older, I got heavy into, oddly enough, after high school, got involved in some small construction company that started during high school. We did underground utility construction, like road and river crossings, directional drilling. I had a small trucking company that did some heavy haul and dump trucks. And then that just kind of morphed into, got out of that and got more into real estate, started buying a few little properties here and there, and then started helping on the finance side. I got connected with some people that were very good at structuring real estate finance. And I did a bunch of deals, probably 06, 07. When we came in, we structured real estate finance and made some pretty big cash fees, spent more than I should have back then, but because you always expect the next $1 million check. But started really then becoming on the equity side of every deal. Like if I helped structure or finance the deal, I didn't just want a cash fee, I wanted a piece of the deal. And it's kind of been a train moving from the station ever since. I've stayed predominantly in real estate, but I do have operating companies. I've got some bar, restaurant, nightclubs that produce quite a bit of cash. Got some manufacturing companies I own a piece of that produce cash. Got a couple of service businesses in the glass business, and then I'm also in the mining business, industrial and rare metals, rare earths, and we got several different mining operations across Africa. Those all produce cash, which I think is very important in the real estate business, not to be just dependent upon real estate. So take that cash and deploy it into real estate. And then a couple of years ago, we formed Your Space America, which Russ formed after his time at North American Self-Storage and some other operators. He wanted to really grow it, and he has the expertise of site selection, entitlement. He's very good at entitlement, excellent at entitlement, good at construction management, wasn't as good as capital raising, at least on the equity side. So I came in with my ability to raise equity plus some of my own cash and some close associates' cash, and then we acquired his first few sites, and we just really started growing that company. And our goal is to grow that company to something massive.
Yeah. Wow. So the experience that you got, like in creating these partnerships, like what are the things that you look for when you're creating a partnership? Because these deals are pretty big, right?
They're big. I look for somebody that's got good operating ability.
And
will do the down in the trenches work. I'm a little bit more high level. I can do down in the trenches. I've done entitlement. I've done it all. a year and a half ago, I entitled an entire subdivision in Alabama that was over 600 lots and 300 acres and sold it to D.R. Horton, which and made a good profit on that. I'm in the home building business in the same region, which is the South Alabama Panhandle of Florida. So I can do all of that, but I look at putting deals together where my biggest skill set is the finance side, the equity and the finance and the structuring of deals. Like we have some JVs that are coming in.
Yeah.
I'm very good at structuring how a joint venture would look. So as long as I can do that and I have somebody else that can do the other part.
Yeah.
And the partnership with Russ was perfect because he was very good at site selection, design, managing construction, being an actual developer. And I was very good at the finance side.
Yeah.
And another friend of mine that's involved, Robert Papiri, is very good at the finance side. So with the two of us handling the debt and the equity and a little bit of the construction when necessary, but the debt and the equity and Russ handling the site selection and construction, the three of us were able to put together a pretty big company.
A power team.
And now, we have 2 sites that are finished. We've got 5 under construction currently, and we've got 10 or 11 in the pipeline along with some joint ventures.
Yeah.
And, these projects are not small. Their total costs are between 20 and the largest one's 52 million.
Yeah.
So they're significantly sized construction projects, and they're going to have values between 40 and $100 million upon completion and stabilization.
Yeah.
So just in what we've got now is well over $500 million once it's stabilized.
Yeah.
And once what's in the pipeline under construction, we'll exceed $1 billion in value once everything's stabilized.
Yeah, and that doesn't include all the joint ventures we're about to start.
Correct. That doesn't include our joint ventures.
Yeah. Yeah, and so I just wanted to unpack that a little bit for the listeners, because a lot of people, if they're looking to get into storage, or just maybe they're interested in storage, because most people are, right? Like, everybody loves the idea of it. But they're big
tenants,
deals.
Toilets, and trauma.
Exactly. Yeah, and it's like, how do you structure the deal, or like how do and what I think the biggest mistake a lot of people do is they go and get a deal under contract, and they can raise the equity, but the missing piece is the operations. And so you obviously have got the finance part, sort of the equity part. You've got a debt partner that can really help with that. And then you have an operations partner.
Correct.
And I think that's like the big lesson for the listeners is like, that's how you properly set up a company, right? And just then divide and conquer based on your actual skill sets, because like there's no way you could be good at all that stuff.
And no way to have the timing. Yesterday I left Dallas. I had a meeting, a breakfast and a regular meeting yesterday morning. Then I left Dallas 10 o'clock in the morning, flew to Springdale, Arkansas for another meeting and looking at an apartment complex that we're involved with that's in an op zone right there in the Northwest Arkansas region. Then I was down in Pensacola for a bank meeting thereafter, then into Miami yesterday evening for a dinner and actually did another podcast. I don't have time to sit there and be doing the minutia.
Yeah. And there's details in here. Like, when we're looking at our entitlements, today we just had another meeting today that this would be one that you would never have time to be on.
Yeah.
Right. But I've got to be in the weeds and that's why we're partnering up, because you can solve the problems that I don't want to do. And I can stay in the weeds and operate, right. And make sure the team is doing it. And it was like you get into in the entitlements and actually design phase, and they're like, hey, we don't meet the green space because of some other rule change. And so now we're back into, relaying out this floor plan, which takes attention, right?
It takes attention. It takes time. And it's also wasted dollars because you're sitting there eating up time and either engineer, architect, or both.
Yeah.
To reformat something.
Yeah. But you need to get in there, get it. Yeah. You can't be in that weeds and trying to raise equity and trying to raise the debt and figure out the debt solution. So yeah, that's cool. So where do you think, you're focusing on development? Have you guys been doing value add as well, or?
We're starting to look at value add. Russ had done it in a former partnership back when he worked at the other storage group. I've done value add in a lot of asset classes, but we hadn't really done it together in storage. We're looking at it, but our development pipeline's been so full. And the lift you get between a piece of unentitled property through the value add of getting it entitled, constructing it at or below a market cost, your lift, you're so far ahead of the game doing it that way. It's been hard to get the same returns out of value add, but we're seeing some deals out there that are worth pursuing.
Yeah, and they're just hard. It's like the private equity came in there like 10 years ago probably.
Yeah, it's hard to make a bid on it because by the time you get it, get under contract and raise the equity, some private equity group,
They could just close on
they
it.
just want to close on it. Even if you're sitting on the cash, the return sometimes is better on a ground up development. But I think there is some great deals out there. It's just you got to find them.
Yeah.
And like I said, a lot of our team is so focused on the development stuff, taking the time to go through them.
Yeah.
But this year we want to make a focus to get at least 2 value adds.
Okay.
The nice thing is you compress the time, you collapse the time from acquisition to cash flow on a value add.
Yeah. And you're probably looking for bigger deals, I would assume. Like even your development deals are small.
We're anywhere between 118 to as much as 330,000 square feet of heated and cooled Gen 5 self-storage. And a lot of them have boat and RV in addition to that.
Yeah. Yeah.
So we're not any small deals. A lot of them are, the one we just finished in Owens in Las Vegas, that one isn't an op zone, is 156 or 158,000 square feet.
Yeah. Yeah. It's big deals.
Yeah.
Okay. Let's just talk about debt. It's like, how are you guys solving the debt for your developments?
We're doing debt several different ways. We've used a private lender a little bit out of Atlanta, Yieldy. They're just a private syndicated first trust deed lender. So they go out and raise the money. We've used a couple community banks and we've used a regional credit union.
Yeah.
I use whatever debt source we can find. I think as a newer company, it's easier to use credit union and community banks and or some smaller regionals that'll get pretty aggressive in the construction lending. Your big, huge banks, they're not going to do it unless you're borrowing $300 million and you've got a portfolio that's already producing cash flow.
Right. And so was that your role in this partnership, to be flying around, creating those relationships?
For the most part, yeah.
Yeah.
I mean, I'm already operating businesses in all over the country, and I have an airplane, which makes life a little bit easier. I can hit multiple places in a day.
Yeah. Yeah, that makes sense. So what are you guys doing for the operations and management? Who's looking after that?
There's a couple of smaller deals that I own that we manage ourselves, but most of our deals, we're doing a management with either Public Storage or CubeSmart.
Yeah.
And they take their little 2 to 4% piece, but we get their national reservation network. If you're moving from Chicago to Houston, you're coming to us because they're going to drive you to us. We get their advertising, their everything. I think it's well worth it. You get a little bit of a premium on the exit.
Yeah.
And sometimes they're your buyer.
They would, especially the big stuff.
At a lower cap rate than anybody else.
Yeah.
So they can be your buyer at a lower cap rate. They drive traffic. And if you do go to the open market, private equity will pay more. So for us, building as much as we have and not really wanting to sit there and lease storage units all day, we'd rather let them run it.
Yeah. Yeah. No, that makes sense. Does that rate, like 2 to 4%, you said? Like I've seen it as high as 6, right?
If you negotiated, you'd get it in that range.
Okay.
And then it depends on your splits on the insurance. A lot of people forget that some of them will split the insurance premium with you.
Yeah.
That's just pure money to the bottom line.
Yeah. That's big time. Cool. So let's talk about, obviously you didn't learn this overnight. Let's go back so before you were doing storage, which is like the last 4 or 5 years.
Yeah.
What was your main focus then?
Before that, it was operating businesses and my single family, multifamily rentals.
Okay. I
would always, and have for 15 years, I'll buy 10 fix and flips, sell 8 and keep 2.
Okay. So that was like the training ground.
Yeah.
Right. Really deal structures, deal flow, capacity.
Yeah. And I would do, I'd buy a section of 4 or 5 acres, entitle it, split it into lots. Then I started getting a little bigger than that. I did some big ones. I've done some, 350 acre, 600 lot, 200 acre, 400 lot subdivisions where I took raw land, entitled it. Usually did a paper lot deal where I flipped them before doing construction, but I've also done curb gutter streets and made pads.
So you've done all the horizontal and then you'd sell the pads after that.
I prefer the paper lot deal.
Yeah. Okay. So let's just unpack that for a quick minute, because there's not a ton of people that even understand what entitlements mean. In Canada, that's how we started cutting our teeth, is by doing, buying a bigger lot, severing it into 2 or 3 lots. It's more or less the same as doing a big subdivision. It's just, obviously the bigger stuff costs more money and there's more risk because of the dollars and the time.
Right.
Do you recommend people to go down that route? Like, how much wealth is created or potential is created in that entitlement phase or the...
Well, a lot of wealth is created there, but I would never advise someone to do that doesn't already kind of understand it. I've learned a lot of the skill set, and I catch some flack for this. First of all, my personality is FITFO. Figure it the fuck out.
Yeah.
I can do anything. And I literally mean that. I think I can do anything.
Yeah. It's because you can. We all
But
can.
most people probably could, but won't.
Yeah.
And entitlement has just so many things that go with it that you got to be kind of cut out to do it.
Yeah.
Picking up a 40-acre parcel in Baldwin County, Alabama, and a 160 next to it, and then closing on that. So now you're out a couple of $1 million.
Yeah.
Then buying under option enough to get your drainage and everything else, putting it all together and selling it off to a big home builder. Yeah, I made a lot of money doing that, but that's not cut out for everybody.
I was at a meeting yesterday, and it was a bunch of real estate agents that have big teams. And actually, his name's Cheplack is his last name. Anyway, he called me out. He's like, "You're clearly psychotic, right?" Because he's also got other developers who are also psychotic. Yeah. It's like, to your point, you got to be cut for it, right? And not everybody can handle it.
You got to be a little bit fucking nuts to be able to
that's
do
what
it.
he was saying. He's like, "Clearly, you're a little nuts." I'm like, "I guess so." Yeah.
Yeah, you pretty well have to be.
Yeah.
Because there's risk in there that you can't quantify on a piece of paper.
You can't find it. It's hard to find it until it's there.
Yeah, I mean, the risk can be you got one neighbor 5 miles over that heard your development's coming and organizes 200 protesters to show up at the council meeting. They're just things you just don't know.
And that could all happen at the last second after you've talked to city council members and P&Z and everybody loves it. And then all of a sudden, 200 letters. We actually just went through this where they couldn't approve it. Actually, no, it needed supermajority vote because of the amount of opposition. It's like I didn't even know that was in Lancaster, in Cedar Hill, Texas.
Oh, I've had one where it was by right, which means the council has to grant it. But they had so much opposition that they pulled me aside, and we're still listening to opposition. The meeting had started at 6 p.m. It was midnight. We're still listening to opposition.
Where was that?
Subdivision in Alabama.
In Alabama.
Because there was light pollution, and it was going to change the farmland, all this crap. And finally, one of the council members on break pulled us aside and said, "We're going to turn you down because we have to. It's our voter base. But you're going to turn around tomorrow and threaten to sue us all individually because we can all be sued individually since it's by right. And then at the next council meeting, we're just going to grant it when
just give you a heads up.
Just give you a heads up. Yeah. You're losing now. You're going to threaten to sue us, and then we're going to give it to you next meeting."
Yeah, it's so crazy how political it is. Do you think storage is more like that than the residential stuff, or was there some asset classes that create more?
Big subdivisions are always going to be a challenge because if that big field next to you has been a blank field for the last 50 years, you don't want it to change, but it's going to change.
Yeah, it's going to change.
So that has a lot of opposition. What gets you some opposition in storage is the stuff we're building. You've seen, very nice, very good looking. Looks more like an office building than
an apartment building, something like that.
Or apartment building than a self-storage. But in people's mind, they think, still roll up doors and trash and whatever. So that's the opposition. And then the cities will give you some opposition because you're not really employing anybody.
Yeah.
One person, two.
Yeah. Their tax base isn't massive.
Yeah. So that you get some pushback. The cities may want other use.
Yeah.
But as long as the home builders, me being in the home building business, I'm not adding closets to my new homes. I'm not giving extra storage space. I'm not getting paid for it. So all these new neighborhoods you see going up have very limited storage. And then if you want to talk about really limited storage, these apartments, these studios have very limited storage. And everybody's got a hobby, whether they're a runner, a biker, a skier, water sports, whatever they're doing. Well, everybody's got to have a place to store their junk or their stuff. And they tend to put it in storage units. So as housing has less and less storage, more people need external storage.
Yeah, for sure. Let's change gears a little bit. We've all made mistakes. Kent Clothier, one of our mentors, or at least my mentor, he says, Brady, when you feel like just failure, he's like, you're either learning or earning. And let me just tell you, I feel like I learned a lot the last couple of years. But yeah, I tend to learn the hard way. But give me a lesson or two that you've learned maybe over the last 5 or 10 years that's really helped change the course of your business or your life?
I think in the up markets where the wind is at your back and where assets are appreciating faster, I don't give a damn what the cost of capital is. If I've got 7% money, 6% money, or 18% high yield debt from a private fund, doesn't matter. But I think when you see the wind slowing, You got to be very careful about your percent of leverage and the cost of capital.
Yeah.
Then you have to be a little more careful and have a takeout ready. You and I both know a lot of the single family guys that got stuck with a bunch of properties that'll never cash flow, that they can't even put them into a DSCR loan without writing a check.
Yeah.
I think years ago, the mistake I think I made was when I first got into doing this in 05 and 06, I was still young, very young.
Before the crash,
was thinking that, money would just fall on trees because, I
you could make it rain.
I mean, I had months then that, my early 20s, I put one deal together and then 1.40 million is $400,000.
Yeah.
Unrealistic for, how much money is coming in.
Right.
You made $1.5 million in 6 months and you made nothing for 2 more years when the market crashed.
How did you get caught up in the market during that time?
I had small equity in a couple of development deals, so I didn't get hurt that bad, but just cash flow dried up. And the stuff that I had bought, luckily I had because I had made some cash, I bought with cash, so I didn't lose any of it. Now I had some stuff under contract and option. I just walked away from that.
Okay.
But it was really about 4 years before any real financing or development came back.
Yeah.
Because everything died middle of 2007.
Yeah.
People didn't realize it was dead.
Yeah.
But deals were starting to crater in 2007. Everybody talks about 08, but a lot of the condo deals, a lot of the developments were all financially cratering a year prior. It just didn't hit anybody's radar till 08 when the banks and the institutions started failing.
Right. Do you see, we've seen a lot of pain in the last couple of years. The debt market.
Banks are going to fail. We just saw one in Chicago fail 2 days ago.
Yeah. You think we haven't seen the worst yet?
I don't think so. And it really depends because there's a lot of commercial debt out there that's up to refi that nobody's going to refi right now. There's a lot. There's a lot of office building debt that's out of covenants. And there's a lot of operating companies that were bought with private equity in the last few years that are levered with institutional debt that has covenants, and they're all out of covenants. Now, maybe nobody does anything. Nobody enforces the covenants and just sweeps it under the rug and continually renews it and just keeps going. But if anybody ever resets any of this stuff, there's going to be some failed banks.
Yeah, interesting. And it's obviously been a challenge getting debt. Like we've seen the number of developers developing storage in particularly, it's like dwindled to very few in the past 3 years.
Debt's relationship based. You've got to use the right sources to get into the right rooms because all the debt now, there's a percentage of it that's traditional big bank, but it's a very small percentage. The rest is community banks and local banks and private debt funds. And those you all have to have a relationship with individually to borrow from.
Yeah, that's a big nugget. So how does somebody go around? Like if you were to, you probably worked at this probably a few years ago and said, hey, we're building this big thing, this big mission. How do you go about, or how do you recommend somebody goes around and trying to create relationships strategically with these people? Like you're a master networker. Every time you're flying around everywhere, shaking hands and kissing babies.
You have to network. You always have to be in the right rooms to meet new people. That's the best way. Secondarily, I use a couple of major debt brokers around the world that do billions of dollars in commercial finance, because when they send your deal in, even if they haven't sent to that lender will know who they are and know that they did XYZ building in New York or something, and you'll end up with a much better reception.
Yeah.
So I use a couple of big debt broker funds that's all they do. They're a mortgage broker, but on a massive level for commercial.
Can you say who it is?
I've used Meridian Financial. Okay. I've used another one out in New York and a few other ones. Meridian's probably the largest. Meridian Capital Group.
Yeah. And so what about, like, a lot of people are looking, they go down to the family office groups, and like, have you went down that rabbit hole before? Or?
A little bit. We've got some debt out of a family office, construction debt that's actually reasonable money. It's not that expensive on 3 projects right now.
Yeah.
And they're, sub 10%, they're sub 9% money. They're very good for private capital. With the family offices, you have to build a relationship and find the family offices that actually will write a check. A lot of family offices want to go into a fund or into a managed equity group or a pooled investment.
To mitigate their risk?
To mitigate their risk and not have to do as much work.
Is it because they don't know real estate per se? Like,
they don't know real estate and they want to mitigate their risk.
Yeah.
And to mitigate that risk, they'd rather just do it with somebody else.
Right.
To getting them to actually underwrite you. I mean, we had to have them underwrite us as a team, us individually, get comfortable with the team, get comfortable with each one of the 3 of us individually, And, we have over, 35 million out in mortgages with them, in 3 loans. And those are substantially sizable loans.
Yeah. Yeah.
They're over 10 million each.
Yeah.
And a lot of family houses don't want to do the work to do that.
Right. So back to the networking. You obviously have your own plane.
Mm-hmm.
Let's just talk about that for a quick minute because it's interesting as heck. I've got my vision boards right there. It's got a plane on it. And I'm not even sure if I want one. We're going to go on it this afternoon.
And you've been on it going out to California
a couple times. Yeah, and it's been great.
Yeah.
It's been great networking, getting to know you, obviously. But it's like a time saver. But just why? How long have you owned planes, and what's been the benefit to you?
I fly private about half the time for really the last 15 years.
Wow.
I've owned Beechjet 400 all to myself. I've owned a Citation Ultra half. I've owned half or all of 4 or 5 different airplanes.
Yeah.
I like airplanes. I'll see a good deal on an airplane. I'll buy it, fix it up and fly it for a little while and sell it for hopefully what I got in it or whatever. But I just like airplanes. But from a business perspective, if I'm going to go somewhere for 4 or 5 days or 10 days, and I'm staying there, I'll just fly up on the airlines usually. Just logistically, it's easier than moving a crew because if I fly the plane up, plane's there, I've got to put in a hangar there. I got to fly the pilots back on the airlines, bring them back, all that stuff. But where I find the plane invaluable to my own life is I can go somewhere in the morning, come back and home in time for dinner, or I can go 3 or 4 places over 1 or 2 days. So, I was in 3 places yesterday.
Yeah, you could never do
that. So in 2 days, I've been in 4 places, and I'll still be home tonight reasonable.
Yeah.
And I'm not wasting any time. If one meeting runs over, other than my day that I've already planned to be tightly scheduled, it doesn't matter.
Right. Yeah, yeah. It makes sense. And I know you were kind of explaining the cost. You're like, Brady, the last time you're like, you can totally do this. You just got to park, I think it was like $500,000 aside per year or something like that.
Yeah. You're going to spend, I run what would be considered a light jet Citation Ultra, but it's still got a good range.
Yeah.
You're going to spend somewhere depending on the year, $500,000 to $750,000 a year to maintain and operate. I use contract pilots. But if you just, park, say $700,000 a year, you're flying a couple hundred hours a year. And just that is what it is.
Yeah, well, it's cost of doing business, right? Because you can probably, I imagine you've been doing it for a long time. You wouldn't be doing it if it wasn't adding value to your business.
I've got shops that I've worked with, so I get maintenance done at a reasonable price.
Yeah.
I'm not taking a Citation to Textron and spending triple what it's worth to get work done. So it's learning how to manage an airplane is a bit of a skill set, but once you do, it saves so much time.
Yeah.
You run up, your meeting runs over. Okay. No big deal. Yeah. You decide to have dinner. No big deal. The only thing is if you do sometimes, which I do, I'll have a 3-stop day and then things running over is a problem, but not because of the flying. It's running over because I've got things booked. I got to be out of here by 11:30 in the morning, back on the plane by 11:50 to be somewhere else by 1 and then to the next meeting at 1:30. But that's, my own choice sometimes, but I like to do that because I can knock out a week's worth of stuff in a day or day and a half and get home.
I've been on the plane a few times and it is insane how just less stress it is.
There's no TSA.
And then you're also doing business while we're on the plane.
Oh yeah. And there's no TSA and you're not dealing with being strip searched before you go anywhere.
Yeah.
At home, I pull through the gate, pull up next to the wing of the airplane, throw my bags on it. One of the ramp guys parks my truck. When I land, my truck's pulled up to the edge of the airplane. I get my truck and I leave. It's easy.
Well, there's a saying, about boats, because I have a 53-foot boat, which is just a small yacht, but it's a big Canadian yacht, small yacht in the U.S. But it was like, what's better than having your own boat? Yeah. A friend with the boat.
It's so
same with an airplane.
I've got the airplane. I've got friends with boats. I've got a couple friends in Dallas that have boats, and in Florida, and one in Puerto Rico. And y'all gonna have the boats.
All right, you just keep the planes, buddy.
Yeah.
Oh, that's awesome. Let's just kind of talk about the future. what is the ideal life for Arthur look like in the next 5 years? Where are you trying to go?
I really want to build the storage into something massive. I think we'd like to exit it into a REIT or some type of public entity. I want to do that.
Yeah. But why?
I can't really tell you why, but
why?
I don't know. Take something public. Be fun.
Okay.
I've done it on some small scale.
So it's not for the money. It's because you want to, because it's about the process. It's about the building the thing.
Mm-hmm.
Like you talked before that you're a builder.
Yeah, I like to build stuff. You can never have enough money, but I have enough money.
Yeah.
To live. So, and now it's just a game.
Yeah, I know. I'm going to go back to something that we were talking about in the truck before we came in here about purpose. And because we were talking about, like you actually made the comment about, there's a lot of these people that go after all the money and then in their 30s or early 40s, they make a boatload. And what happens? Like, what have you seen?
I've seen a lot of founders more on the tech side in their early 30s get a big exit, or maybe in another type of company in their 40s, or even some manufacturers in their 50s, all of a sudden get a big exit, or they sell a big chunk of their company. And all of a sudden they went from a good net worth to now liquid 50, 100, 200 million in cash. And then they'll stay on for a year or so, but it's no longer their baby, or 2 years. And then when that's out and they're out the door, they can have some serious issues, because you're talking about a guy that's been 120 hours a week, 24 hours, 365 days a year, thinking about what he's building. Now he doesn't have anything to do, and a big pile of cash with nothing to really do. Yeah.
And I think that's just the reason why I want to bring that up, is because I found myself chasing it for sure. And like, just, hey, if we have this number of deals, like when I first started, our goal was 12 properties, right? And then like in the first year you get your 12 and it's like, okay, now it's 20, then it's 30 and it's 40 and it just keeps growing. And what never changes is the feeling. It never makes you feel better.
No.
Have you ever felt like that? We're like, oh, I made it? Or
I mean, everybody has stages where you feel, oh, I made it because now I have this or that or whatever, but it doesn't really change how you feel.
No.
You're still you.
Yeah.
I've noticed a lot of other people have their own opinions about how you made it, or, oh, you must be perfect because you have all this. But, no matter how wealthy you are, and until you get into the multi-billions, that's a different category. But no matter how wealthy you are, you always have money issues. They're just bigger money issues.
Right. Yeah.
If you're a developer building $30 million deals, you're not worried about a $50,000 new car or a $10,000 repair or something happened at the house for $20,000. None of that bothers you.
Yeah.
But all of a sudden now
you've got $1 million problems instead of $1,000 problems.
Yeah. And all of a sudden now your bank, instead of loaning you 80%, is going to loan you 70%. And now you need, with reserves in this, you need another $3 million out of thin air. So your problems just change.
Yeah.
The commas move.
Yeah. And I think that's just like that example right there that you just said is a perfect example of just be cautious on just chasing things for money or for, to be bigger and be more, because it doesn't make you feel better. It just feels the same. It's just like, I remember when we first started doing our first deals, $1,000 was scary. Right. Now, then it was $100,000. It was like, like now that's gone more. So the feeling doesn't change, but so we have to find other ways to find purpose.
Yeah. It's like you worried about 1,000 or 10,000 earnest money check. Then the earnest money checks get to 100,000.
Yeah.
Then they get bigger than that. So.
Yeah. Yeah. And I think, I just want everybody to connect the dots while they're listening to that. Cause I think we can all recognize like, oh yeah, I've been chasing that. And so if you're chasing it and you haven't, just recognize how you feel. Is maybe just try to mix in something that actually will give you purpose. I mean, we're doing the 0 to 100 wishes. We're raising $1 million to give to make a wish. And that's going to impact 100 children's lives. So for me, it's the same skills that we're doing in business, but that, I'm not going to make any money from that. I'll probably create some great relationships. There will probably be something that comes my way.
But due to those relationships, you'll make some money.
We'll make some money. Yeah, it always comes back. But that is, that drives me, or that I know makes me feel better in my heart, right? Where 100,000 in the bank account doesn't, and so that's cool. That I just, I appreciated that part of the conversation today.
Yeah, it's kind of like with charity. I argue a little bit, I know some people that give a lot to charity, but they give little amounts to a tremendous amount of charities, which is great. No problem with that, but doesn't move the needle for anybody. Maybe if you took that same $100,000 you were going to give and gave it to 2 charities.
Yeah.
At $50,000 a piece. Now you move the needle in something.
Yeah. Yeah. 100%.
Because then you've actually done something that they can quantifiably say, okay, you're giving me this for this. They go do something.
Yeah. Yeah. 100%. And a lot of when I've raised money for, obviously when you're raising money for storage, you're saying, hey, for the $100,000, you're going to get this. And so what I've done successfully, I've raised like $94,000 for running 100 miles. And in that, I'd be like, hey, if you donate $1,000, I'm going to run a mile for you. Right. And it's like, so then they can, or
they get something.
They get something. They're like, okay. And then you can, it's the same way.
And if you do another 240 mile, do you say it's actually 2,000 a mile? Because it's
$1,000 a mile, baby. Let's go. Yeah, I know 300 coming up, but anyway,
you're doing a 300-mile run.
Yeah. In 6 weeks.
How long will it take to run that?
It's going to take about 5.5 days, I hope.
And how often do you get a short nap? How does that work?
So you sleep whenever you start to sleep walk, right? And so the first night usually I won't sleep at all, and then I'll start having dirt naps, like 1.5 hour naps per day. And then hopefully, the last race I did 240 miles was I had a 5-hour nap once, but so 9 hours of sleep.
9 hours of sleep, 240 miles, and how long from start to finish?
That one was 101 hours straight.
Yeah,
but so developers are crazy.
Yeah, we're crazy. I'm not that crazy.
I just haven't exposed yours yet. We haven't got there yet.
Yeah. But good God. So you're going to do a 300 miles.
Yeah.
You're going to do it in 6 days?
Yeah, it's going to be about 6 days. So again, it's all like the reason why is like God asked me to use my legs for something better than, ego or further distances. And that's all part of raising that $1 million for charity too. So
that's awesome.
But yeah, so okay, let's just pop back over to storage. So you're always raising money.
Always.
And how do you structure your offerings when you're raising money and you're getting investors?
It different in some of the deals, but our standard offering is more of a hedge fund institutional offering. We're paying between a 6 and a 10% pref depending on the deal. So you're earning a pref from the day the money goes up. And then we're 80-20 until a certain threshold, then 70-30. And then if there's some home runs, we can get all the way, and some of them to a 50-50. But most of them will only ladder back to 65-35.
Yep.
We have one that we got the land really cheap, and we're all going to make a 40% IRR even at a 50-50. But our standard deal is 80-20 with some waterfalls that if you make more, we make more.
Yeah, that's good. And so if somebody wants to get a hold of you, Arthur, and to invest in one of the deals that you currently, are you raising money right now?
We are.
Are you ever not really raising money?
Probably not. I mean, we were fully raised at the end of the year, and then we got our construction bids back to start 3 more projects this year. So yes, last year we raised about $75 million in equity.
Wow.
And we'll probably do the same this year.
Yeah. Okay, so what do you got in the pipeline?
We've got a deal coming up in Henderson,
Arizona,
Nevada,
right?
And we just started construction in Tucson.
Okay,
we just completed 2 in Las Vegas.
I saw those openings.
We have a new one in Las Vegas, Mount Hood, that started, but that one's pretty much fully committed. There's a little left on it. There may be $1 million, but that was a big raise left on that one. And then we got Bakersfield, which is an opportunity zone. So anybody that's got any deferred capital gains issues that needs to defer capital gains, study on the opportunity zone or talk to me, but you can kick the can down the road. Then any gain in an op zone deal that we hold for 10 years is exited tax-free.
Yeah.
So we've got that. And then we got 4 more in the pipeline. So we're always raising, but we're going to raise specifically for the Henderson deal and what little bit left on Bakersfield right now. They can always reach me at info@arthurhood.com, ARTHURHOOD.com.
We'll drop that in the comments.
Yeah.
Okay. All right. Who's your ideal investor?
Ideal investor is somebody, our technical minimum is 100. We can do less. They got to be accredited, although we are now going to set up with Stella.
Oh, are you?
A pooled group. So
Investor club.
So we can now do non-accredited.
Yeah.
That'll be ready in a couple of weeks. But
yeah, that's pretty cool. So make sure you follow Arthur on that one, because you're essentially going to create your own investors club.
Right.
So then accredited, non-accredited, doesn't matter. You can invest, and you might have minimum in that as well. But do you know any rules?
We don't know what minimums we're going to. It's a self-chosen minimum, probably $10,000 or something.
Yeah, so it makes it much more accessible to everybody.
Because our current minimum is 100. One unit's 100.
Yeah.
We can do a quarter unit for 25, but you still have to be accredited.
Right.
We've done that for people that want to do 250,000, but they're spreading it amongst kids' trusts and things like that. So it's a bunch of 25s, but our normal deal is a minimum of 100.
Yeah.
Just because most of our deals are, 6 to 10 million of equity.
Right. Hey, I got a question. This is I know you'll know the answer probably anyway. Don't want to put you on the spot, but can somebody 1031 their an apartment deal into a fund, or say into one of our joint ventures or something like that?
Yes, we can structure 1031s. There are times that we're, fully locked up on a deal and what we could do in 1031 we can't do, but generally we always have something in the pipeline that we can do a 1031 with.
Cool. Yeah. Okay. We need to talk about that because that could help. That could work a lot with our stuff too. Okay. Cool. All right, Arthur. Well, it's been a pleasure chatting with you. I think we unpacked a bunch of stuff. And again, everybody, make sure you follow. Should we follow you on Instagram or Facebook or something?
Yeah, we'll drop a link to that. It's I think Arthurhood. Something.
We'll get you on that. But anyway, message Arthur. Honestly, there isn't somebody that has raised more money than Arthur that I personally know. So, and you're a good steward of money. So, awesome, buddy. Appreciate it.
All right, perfect.
Yeah, thanks a lot.
Thanks for listening to the Self Storage Development Podcast. If you got value from today's episode, hit subscribe and share it with someone in the self-storage space. For exclusive, fully entitled self-storage development land opportunities and to stay updated on future episodes, head to barefootlandco.com and join the newsletter. I'm Brady McDonald. Appreciate you being here. Until the next time, keep building.